Hey, what's going on, guys? It's your favorite millennials coach here today that teaches you all the things about personal finance. And today we're going to be taking a deep dive into how to get started in investing. Take a look at what the risks are, how to make smart investments, and lastly, we're going to go into a deep dive or step by step on how to open up a brokerage account and get you started in investing today. The most important reason why people should be investing into the stock market or investing their money somewhere, whether it's real estate, the stock market, bonds, art, bags, watches, whatever it may be, it's very important that young adults especially get their money invested and working for them. When your money is sitting in the bank, one of the biggest risks is that you're losing your money to inflation. And this is the first of the risks that we're going to dive into, or the first of the risks that we're going to explain. So inflation is basically when your purchasing power goes down, but your money's staying the same. So if you had $100 in your bank account last year, basically you only have $95 worth of purchasing power because we had a 5% inflation rate over the last 12 months. What this means is that the cost of goods went up 5%. So technically you're only able to buy $95 worth of goods now with that $100. So the second type of risk is actually an interest risk. Interest is basically the amount of money that they charge you, or a bank charges you to borrow money. So if I want to buy stock on margin, which is basically borrowed money, they're going to charge me 7, 8, 9, 10%. So if I'm borrowing $100, they're going to charge me $7 every single year to borrow that money. So it's basically the cost of borrowing money. Interest and margin is a risk in the stock market because you're assuming you're going to beat what they're charging you interest. So if they're charging you higher interest at 10%, you're going to have to beat at least 14% returns in order to make your money back. So you have 10% for the interest, and then you have the 4 or 5% that they're charging you or that you're losing to inflation. So the third and most common risk that is understood by investing in the stock market is a market risk. The market risk is basically what deters many people from investing in the stock market, and that's simply because they're either buying bad investments or they just simply don't understand it. Market risk is basically if you're buying a stock at $200, it has the risk of falling and you selling it when it falls. If I buy a stock for $200 and it has a bad year or some reports come out and the stock drops to $100, that risk of $100 could be me selling it at $100 and losing 50% of my initial investment. This can be avoided by making smart investments and even investing in ETFs and index funds where you don't really have to worry about one company's performance. So some of the ways to avoid the risk in the stock market, or whether you're investing in real estate or whatever the investment may be, you need to have a plan for avoiding this risk. Well, the first one is diversification. Diversification means you're not investing all your money into one type of asset. So you may invest some into stocks, you may invest some into ETFs, you may invest into real estate. Just make sure you're diversified and that you're spreading your investments all over and it's not just in one company. The reason why is because if you have all your money in Apple, Apple's a great company, but there is a time where Apple could fall. And if it does fall and you have all your money in there, you basically lose 100% of your assets. On the other hand, if you're investing into something like an ETF or an index fund that has a company that has 500 companies within that ETF, that means if one company fails, you still have almost 500 other companies to back you up. The next way to minimize risk is to make sure you're budgeting or not putting too much money into your investments. I like to follow the rule 10 to 20% of your money should be into the stock market. You still want to have your 3 to 6 months emergency fund. You still want to be paying down debt, and you still want to budget some money for yourself. Do not put all your money into investments, and definitely do not put all your money into one type of investment. So many people are overwhelmed when they get into investing because they don't know what to invest in. There's things like stocks, ETFs, mutual funds, index funds, bonds. No one knows what all this means at the beginning. So it could be very, very overwhelming to get started. So the first thing that I'm going to talk about is the simplest one, which is bonds. A bond is basically an IOU. So if you're buying a treasury bond at a 3% interest rate, this means you're now giving the government $100 or whatever the price may be, and they're going to say, in 1 year, I owe you $103, 3% more than what you gave me. Bonds are usually very safe investments that people like to just grow their money and match inflation. They don't use bonds to get rich or get wealthy. It's more of a preservation of wealth rather than a get me wealthy. Next is stocks. A stock is basically a portion of the company. So if we want to take Apple, for example, because it's just the easiest company to talk about, and it has 100 stocks, that means there's 100 pieces of pie of this company. So if I buy one stock, that means I own 1 out of the 100 pieces of this pie, which means I own 1% of this company. Picking good stocks takes a lot of effort. You need to look into their reports, their earning reports. You need to see how much cash is coming in. You need to take a look at their debt, how they make their money, their competitors, and so on. So picking individual stocks can get very complicated, and maybe one day we'll talk about that and go into a deep dive on how to pick a good stock. looking up a balance sheet and stuff like that. But the next type of investment that I want to talk about is my personal favorite, which is ETFs, mutual funds, and index funds. These are all pretty similar, so I'm going to talk about ETF. Well, an ETF is basically a Halloween basket of companies. VOO, which is my favorite ETF, is basically a Halloween basket that contains 500 companies. It owns Apple, Nvidia, Microsoft, Tesla, and so on, and 490 other companies. And what this does is it does the diversification for you, so you don't need to go and purchase 500 companies. So if one day Tesla fails and you own VOO, Tesla's in VOO, but you still have the other almost 500 companies to back you up, like I said earlier, in diversification. Investing in index funds is really, really easy. You want to look for a low-cost index fund, like I said, VOO or VTI or VT. All these are low, passively managed index funds. Passive index funds or ETFs means that there isn't someone who's actively trading for you in this fund. So you're not going to have too much movement in what's actually in this ETF. Passively managed ETFs you could find as low as 0.03%, and I think that works out to $30 or $300 every $10,000 invested. So as you can see, it's very, very minimal, and it's very little work involved in investing into the ETFs and index funds. So as a beginner, if you want to jump into bonds, those are very safe, they're very low risk, but you're not going to see much rewards, and there's not much to it. Stocks can get very complicated. I wouldn't recommend, or I don't invest in individual stocks much. I do have a few companies that I dip some of my investments in, but not more than 1 or 2%. But just because as a beginner, you really want to start off with index funds. Index funds are an easy way to jump into the stock market, see how the movement is. Every day the stock's going to go up, some days it's going to go down, some days it's going to go up, some days it's going to go down, and repeat. So what I would do as a beginner, if I was to start today, I would open up a brokerage account, which I'm going to show you guys here in a few. I would invest maybe just $10 into VOO. This way you can see how your money is going to grow. You can see how your money is going to fall. And once you get more involved, and once you understand the stock market more, you can look into different types of index funds, or maybe even dip into a stock that you understand. When it comes to individual stocks, you don't want to invest in random things. So if I'm a doctor, I'm going to focus on things that I understand, being in the medical field. I'm not going to go invest in, a robotics company. But on the other hand, if I'm a robotics engineer, I'm going to want to look into this robotic company and invest into that. So I think that's one big thing that people need to understand when investing into the stock market is only invest in what you understand. Don't follow the biggest hype trains. Don't follow the biggest social media stock, the biggest meme stock, because that's never going to work out for you. And investing in the stock market is definitely not a get rich quick scheme. So if someone tells you the stock's going to blow up, I've read reports that it's going to go to $10,000 in 2 days. Don't believe them, because no one knows what's going to happen in the market. And if they do, it's insider trading and it's illegal. So now that you got the rundown on the risks, how to make smart investments, what to invest, let's take a dive into the different types of brokerage accounts and what you guys should start off with. Well, there's a few different types of brokerage accounts. The first ones that I'm going to talk about are tax advantage brokerage accounts. These are things like Roth IRAs, 401ks, HSAs, and so on. Well, a Roth IRA and a 401k are both tax advantaged accounts that are retirement based. So you cannot withdraw the money from this account until you're 59 and a half years old. A Roth IRA is an individual retirement account. This means that you don't need an employer in order to open one of these, unlike the 401k, which is employee sponsored. So within these accounts, there's two different types. There's a Roth, there's a traditional. A Roth means that you're investing with your net pay or your post-tax pay. So once you retire, you're not going to get taxed at all, whether it's a Roth IRA or a Roth 401k. With traditional, you can go the traditional route, and before you get taxed from your paycheck, you're going to have money withdrawn from your gross pay or your pre-tax pay. So you're not going to get taxed on that money going into the traditional 401k now, but you will when you withdraw. Each of these have their own advantages. I'm not going to go too deep into which one fits for you. I do have a video if you are interested in that on the advantages of each account. Take a deep dive into those. Lastly, there's a normal brokerage account. These are your Robinhoods, your WeBulls, your Fidelities, your TD Ameritrades. These are the ones that you're probably going to want to start off with just to see how things are going. Eventually, you do want to open up a Roth IRA, but like I said, watch the other video, talk a lot more about that. So these individual brokerage accounts are not tax advantage. You put in taxed money, and when you take out your gains, you're going to have to get taxed. I personally use Fidelity. That's a bit more complicated, but it's not too hard. I would definitely recommend that. Robinhood is one that I use for smaller investments, but with Robinhood, it is designed like a casino. They add colorful lights all over the place. They have their greens, their reds. It's really meant to encourage people to day trade and make many transactions, which I don't think you should be doing at the beginning. But it is very user friendly. So if you do have the self-control and you believe you can stick to long-term investing, try out Robinhood or look into Robinhood, maybe even WeBull. As you learn more, you're going to want it to get into something more secure. I would go into TD Ameritrade or Fidelity. These are both good options. But what best fits for you? Take some time, look into the different options that are out there and go with your gut or what best fits you guys. So to get specific on exactly how to open up a brokerage account, let's talk about the steps. So step number one, you need to do your research and pick one account to open, whether it's Robinhood, TD Ameritrade, WeBull, Fidelity. Pick and stick with that. Next, you can go to their website and you should be able to open up an account. From here, they'll ask for normal information. They'll ask for your social security. It's completely safe. Don't worry, you're not gonna get scammed. They'll ask for your phone number, your email, your name, and so on. Once you have the account opened up, you can either put in a one-time deposit or you can set up recurring deposits, which maybe every time you get paid, you wanna put in $20. You could go that route, but for now, start off with putting in maybe $10. From here, Monday through Friday, from 9:30 to 4 p.m., you're able to buy stocks within that account. So I would say put $10 in, buy some type of index fund, some type of low cost ETF, and see how that plays over the next few weeks. If you're starting to get an understanding on how these things exactly work, you can start doing the recurring investments. You can maybe put some more money into there and continue your road to wealth. So in summary, today we went over what the risks are in investing in the stock market and not investing in the stock market. We went over how to make smart investments, whether it's an ETF, a stock, or a bond. And lastly, we went over how to open up an individual brokerage account. So I would encourage all of you guys to get your money working for you, open up some type of account, whichever one you decide to pick, and put in some money into low cost index fund or one stock that you like. Maybe you shop at Target, buy $10 of Target. Maybe you like Starbucks, buy $10 of Starbucks. So if you do have any additional questions, you guys can reach me through Instagram DMs. You can send me an email, drop a comment below, subscribe to the page as it really helps me out and to support the page. And with that, we'll see you guys in the next one.